Good afternoon, everyone, and welcome to part three of our From Wealth to Legacy webinar series. My name is Jeff Elastigui, founder and managing partner of the Legacy Group. I want to thank you sincerely for joining us this afternoon. This series is designed specifically for high earners who've done the hard work of building income. Now it's about focusing and keeping more of what you earn, building flexibility, and making smarter long-term decisions around taxes and building long-term wealth. Before I jump in, I have a brief but important housekeeping note. Today's discussion is educational in nature. We'll be talking strategy and concept, not giving individualized advice or legal or tax advice. Think of this as a blueprint, not a construction crew. Your CPA, attorney, and advisory teams are still very much going to be important in this process. We're just hoping that they're all talking to each other as we do so. All right. So the Legacy Group, our mission is simple but powerful: to help you live a life of greater confidence, choice, and financial freedom. We do that through a three-dimensional planning approach, integrating investment strategy, tax planning, estate planning into one coordinated system. This process allows us to identify coordination gaps, planning opportunities that can have a significant impact on your legacy that you leave behind. So where are we headed today? We'll start by framing the high earner tax landscape. What's changed, what's getting more complicated, and why reactive tax planning no longer works. From there, we're going to dive into some tax diversification ideas, asset location, and then ultimately share three of the most impactful ideas that I think we see having an impact on high earners, and that's Roth conversions, the Mega Backdoor Roth, and using life insurance as a tax-advantaged asset. And at the end, we'll have some time for some Q&A. Before we start, I think it's important for us to really remind you of the key takeaways from the first two sessions. So there were really three big principles that I think that are important. The first one was, creating and having a disciplined saving structures creates optionality, right? So the sooner you start saving, the quicker you start creating that flexibility and option for yourself in the future. Equity compensations requires intentional risk and tax management. So we talked into depth when we talked in the RSUs in the last session. And lastly, cash flow clarity leads to better investment decisions. When these three pieces work together, that's when you start seeing tax alpha, right? It's not from the complexity, but rather the coordination of the three things happening together at the same time. So today, we're going to focus that conversation through that lens. So this afternoon, we have two speakers, Matt Wilco and Rob Sturgis. Both are my partners who I love, great people. Don't take my word for it. I would really suggest you meet with them and find out why. Matt, it really is a wonderful planner, focuses on business planning, retirement strategies, and income protection, particularly for high earners who are negotiating and navigating high complexity cases in terms of transitioning from business to business or a high-paying job to another high-paying job. Rob Sturgis brings nearly 2 decades of experience, retirement planning, wealth management, and business strategies with a deep strength in management, risk management, and long-term planning. Together, they're going to talk to you through the tax planning and proactive ideas that we can take, from this session. So, Rob, Matt, take it away, guys.
Thanks, Jeff. Like Jeff said, my name is Matt Wilco. I'm one of the partners of the Legacy Group, and I'm going to start with this first segment, which just kind of gives a brief overview of high earners and the tax landscape. So moving into the first slide, why tax planning matters for high earners. So obviously there's a lot of reasons, right? We've narrowed it down to a few that we'll cover in the next minute. The biggest is really income volatility, right? So most high earners have some level of volatility with their income, right? And one of the reasons being is that most high earners receive income in a lot of different ways, right? It's not typically just a salary like it is for a lot of folks in America, right? A lot of high earners receive a salary, but a lot of times they also receive bonuses, they receive commissions, they receive stock options, RSU grants, profit sharing agreements, all of these things that we typically see with most high earners that additional income, while it's wonderful and it's a good thing, it does potentially create a lot of tax challenges. And if we're intentional and we have good planning going into a good planning strategy before we receive that income, it can help us mitigate unnecessary tax liabilities to the IRS and or the state that we live in. So the second thing is concentrated equity exposure, right? So very often we find that high earners have been given stock options or RSU grants. And very often those that stock that they own, that they have equity in, has done very well, right? And it can sometimes take up a large portion of their wealth, right? So first off, this is obviously a good thing. We all want to own a stock that has done very well, and it's a good problem to have it take up a large portion of our wealth. But it is in itself a problem, right? We talked about in earlier webinars on this topic that, it creates a risk issue if too much of our wealth is tied to one position, right? It goes back to the very old saying of don't keep all your eggs in one basket. And this, having too much equity in a single position is having too many eggs in one basket. So is it as simple to say, just rip the Band-Aid off and sell all the equity to divest and lower risk? Probably not. Sometimes maybe yes, but more often than not, no. And one of the major reasons why is because that could create a huge tax problem. So when we work with high earners that have a concentrated equity position, it's balancing the risk that inherently is putting them in, but also making sure there's a sound strategy that is not unnecessarily giving more money to the IRS than we need to. The third bullet point that you see there is rising tax complexity, right? So I don't think anybody in America, if you ask them, are taxes easy? They say yes, right? If you followed up that question and said, do you think taxes are easy for lower income people, middle income people, or higher income people? Most folks would probably say that the higher income people are going to have more complex tax situations, right? And this is for a variety of reasons. Like I mentioned before, there's high earners receive income in many, many different ways. That in itself creates a lot of tax complexity. But on top of that, the way that the tax code works, and we're going to talk about it in the next few slides, as you start making more money, there are more taxes that get kind of piled on top of each other. And then there's less and less deductions and credits that you're eligible for as you make more money. So it just creates a very, very complex compounding tax system that when you are intentional and you have good planning behind it, it can create opportunities. If you ignore it and you don't have good planning, it can create a lot of unnecessary problems. All right? So moving on to the next slide. We're going to talk first about federal tax considerations, and then we're going to move into state tax considerations. So we'll start with talking about marginal brackets and effective tax rates. So very often I'll meet with a new client and, they'll say, well, federal taxes aren't too complicated, right? You have your bracket and, I made $1 million in 2025 as a hypothetical example. I'm in the top tax bracket of 37%. What more is there to talk about? Well, it actually doesn't work that way. And it's actually a good thing that it doesn't work that way. The way tax brackets work is that the first tranche of income that you earned is taxed at the lowest rate, which is 10%. Then the next tranche is taxed at 12%, then at 22%, 24%, so on and so forth, as you move up the tax brackets all the way to 37%, right? That's a good thing because that means that hypothetical client that made $1 million doesn't have that entire million taxed at 37%. They have different tranches of that income taxed at different amounts, right? Which then leads into what we call an effective tax rate. The effective tax rate is to say, okay, look, if we averaged out all those different tranches, right, what is the actual percentage of that million that we owe in taxes? And, hypothetically, let's say it's 32% when we factor in the lower tranches of income, which were taxed at the high 37. Second bullet point that you'll see there is net investment income tax of 3.8% surtax, right? So first off, what is investment income? Investment income is things like capital gains. It's things like rents, royalties, interest, dividends, things along those lines, right? So when we receive that income, right, it isn't always just taxed on in a federal tax bracket, right? It's taxed separately as investment income. And then so that could be like a 15% capital gains tax rate or a 20% capital gains tax rate. On top of that, if you make above a certain amount of money, the government levies this 3.8% tax on top of the capital gains you pay. So if you're a high earner and you have capital gains, you might be subject to the top rate of 20%, but then on top of that, you have a 3.8%. So now you owe the federal government 23.8% on that, and a lot of people sometimes forget about that surtax. The third is alternative minimum tax. And, when I was new in this business and I was working with an accountant, they explained AMT to me like this. And the analogy always stuck with me. To understand AMT, kind of imagine that you're filing two tax returns. And the first tax return, the software runs it and says, you're eligible for every deduction and credit that's out there, regardless of how much money you make. And let's say the return is run and it says that you owe $125,000 in taxes. Well, what AMT is it says, well, the IRS says, well, hold on a minute, because you make a lot of money, we are not going to allow you to be eligible for every deduction and credit that's available, right? So we're going to scale back the amount of deductions and credits you can take. And when we run our AMT tax return, we may owe $150,000 as opposed to $125,000. And the IRS says that we always have to pay the higher of the two. So AMT essentially is a way that the IRS limits the amount of deductions and credits that a high earner could take, forcing high earners to pay a little bit more. And that's a good segue into the last or the second to last bullet point, phase outs and cliffs, right? So when we talk about federal taxes, income taxes, there's less and less cliffs. The main one is around, healthcare and Obamacare. The biggest cliff that we see is very frequently with estate taxes. Here in New York, where our practice is based out of, we have an estate tax. And if you fall, there's a very famous thing that's called the New York State estate tax cliff, that where if your estate surpasses a certain amount, it's roughly $7.5 million, you now fall off a cliff, right? And the entire estate is subject to a tax, right? So literally, if you were $1 under that 7.5 million, that rough $7.5 million number, you may only owe $100,000 in taxes. And now that you're $1 over, you could owe $500,000 hypothetically, right? So obviously that's something that a lot of planning needs to be looked at with that, because it would be a real shame if you just fell over that cliff a little bit, and as a result, we're subject to a lot of taxes that you didn't necessarily need to pay if you were under that. When we look at federal income taxes, the majority of it is through phase outs, right? That's typically what they've gravitated to over the years with our tax legislation. And how phase outs work is it says, okay, once you make a certain amount of money, call it $200,000, a deduction that is available to everybody, you now start phasing out of it. Right. So it's not a cliff where you make $200,000, you can't take this deduction at all. It says maybe you can only take 70% of the deduction once you eclipse 200,000. And then once you eclipse 300,000, you can only take 50% of it. And then at 400,000, you can't take any. So it's a sliding scale down that limits the amount of deductions and credits that high earners can take. And then lastly, impacts of RSUs, bonuses, and equity events, right? Any of these large liquidity events have large federal tax implications that planning is often advantageous to do beforehand. So if we move to the next slide. Now we'll briefly talk about state tax considerations. And the first is, most simply, are you in a high tax state or a no tax state, right? The amount of state tax considerations we need to make here in New York, obviously a high tax state, is very different than what a client in Florida or Texas need to do, where it's a no tax state, right? And it's not just about the income taxes we pay, it's about capital gains taxes, right? Here in New York, when we have capital gains, not only do we have to pay that to the federal government, but we also have a New York State capital gains tax that we have to pay. And then different retirement rules. Different states have different ways that they reconcile distributions out of IRAs and 401ks for retirees. Some have very favorable rules, some have very punitive rules. So all of that needs to be analyzed. Second bullet point is residency and domicile, right? So very often in New York, we'll meet a client that says, well, I'm going to buy a place in Florida. I'll declare, become a Florida resident, and now I don't need to worry about New York State taxes anymore. Well, unfortunately, it's not that easy, right? So, New York State, along with many other high tax states, look at, well, where are you domiciled? Where are you spending most of your time? right? Just owning a property in another state doesn't necessarily, in New York State's eyes, necessarily mean that you're not subject to New York State taxes, right? It's about how much time you spend there. Moving to the third bullet point, temporary relocations and remote work. We have clients that sometimes are traveling 300 days a year, different states, right? Sometimes internationally, right? How does that affect their, what they owe to the state that they're a resident of, right? State-specific rules on retirement income and estate planning, right? Like mentioned before, different states reconcile distributions out of retirement accounts in different ways, right? Estate planning, different states have different estate taxes and different rules over whether you pass away with a will, without a will, and what kind of impact that has on your assets. All of this lends opportunities for strategic timing and income moves. So if you move to that. And lastly on this, this segment here, the difference between tax planning and preparation, right? We like to look at preparation as filing your tax returns, right? Which is what you have an accountant, a CPA for, which is what we're not, and what we're certainly not looking to displace for any of our clients, right? Every year you need to file that tax return, right? What we're focused on in conjunction with working with our client CPAs is the planning, which we like to classify as designing your lifetime tax path, right? It's not just about taxes you pay today, it's taxes that you're paying over your life. And the goal is to reduce lifetime tax drag as much as we possibly can. So that is a good segue into the next section. I'll hand it over to my partner, Rob.
Sorry about that. Thank you, Matt. Great job. The next section, what we're going to talk about is diversification. In the past, most people, when they focus on diversification, they focus on allocation of assets. How much of my portfolio is going to be set to stocks? How much is going to be set to bonds or fixed income? What a lot of times is overlooked is what we call tax diversification. Pam, if you go to the next slide. Tax diversification, essentially, it's intentionality. It's the thought process of what dollar am I going to save and where am I going to save it and for what reason am I saving it in that bucket. It's the intentionality of changing or saving assets across traditional or pre-tax buckets like IRAs and 401ks, Roth accounts, and tax accounts. One of the things we always say, it's not what you earn, it's what you keep. Now, in most cases, that's just talking about a saving strategy. But in this case, it's talking about what happens to my assets as they grow and as I transition through various stages in life, from my accumulation stage to my distribution stage to my passing stage where I want to leave my assets to my loved ones. Having a clear plan, as Matt mentioned earlier, and diversifying your buckets amongst multiple tax-treated accounts is key towards setting up a successful plan for the future. It provides you the ability to have flexibility in retirement. It potentially creates assets that are more efficient to pass down to the next generation. More importantly, it potentially can help set you up to or mitigate future taxes that may be in an unknown bracket, or worse, potentially unknown to some of you today. There is something we're going to discuss a little further later on in the presentation, but there's something called IRMA. And assets that are invested in various accounts are counted towards that IRMA calculation, whereas assets in different buckets are not. So having the foresight to plan properly now could potentially save you thousands, if not millions in the future upon your lifetime and those of your children as you leave assets to them. So, well, again, as I mentioned earlier, it's the intentionality of allocating your assets towards different buckets. It's taking a look at what you're earning, what you're spending, and what you're saving. Once we take a look at that savings component, where am I going to save it? In years past, the greatest advice anyone could ever get was max out a 401k, lower your taxable income, and save until you retire. At that point, you're going to be earning less money, you're going to be in a lower tax bracket, and therefore you're going to pay at a much lower dollar amount. But that's one thing that gets overlooked in that. Most people, when they invest $1 today, they do so with the thought process that when they need it, that dollar is going to be worth 10. What they also don't realize is that when people plan for retirement, they plan to generate roughly 70 to 100% of today's income adjusted for inflation throughout life expectancy. So if that's what your plan is, are you truly ever going to be in a lower tax bracket? And on top of that, do we know what the tax brackets are going to be in the future? So sometimes it might make more sense to pay tax on a dollar today to not have to pay multiple taxes on $10 later. The other thing we want to focus on is as we've diversified our assets into multiple different tax treated accounts, what are we going to do when it's time to distribute or withdraw money out? Are we looking at times where we have a period of time between today and the point where I need to take distributions because I've hit what's called the required minimum distribution age? So do I have a lower tax bracket that perhaps it makes sense to draw more money out now from a pre-tax account that would becomes fully taxable because my earned income is at a lower stage and I can take advantage of a lower tax bracket? Conversely, if taking money out of these accounts in an earlier stage in life, it potentially could limit or minimize what your required distribution will be in the future. We say this all the time, and I've said it a couple of times already in the few slides that I've been speaking, but for pre-tax accounts, your traditional IRAs, your traditional 401ks, they are great vehicles for accumulation, but they are one of the most inefficient assets that we can leave to our loved ones that are not our spouses. The current Secure Act and the law states that they have to deplete that account within 10 calendar years. Well, if you look at the traditional time of when people lose their parents, it's typically when they're in their 50s and 60s and at their peak earning. If we have to now take a distribution over the next period of time of our 10 highest earning years, at the end of the day, we may only be seeing 30 to 50% of the asset our parents worked their entire life to accumulate. So having the foresight to plan for the next generation helps make sure that one of your biggest beneficiaries is not Uncle Sam, but rather the loved ones that you intended to leave everything to. Pam, if you can go on to the next slide. One of the things I mentioned earlier is it's not what you earn, it's what you keep. And one of the best ways to do that is not just in terms of a saving strategy, and it's not what you own, but rather where you own it. There are more efficient ways for you to own assets based upon what they kick off. For instance, if you happen to own bonds or income funds, real estate investment trusts, money market funds, and CDs that tend to kick off dividends that will be treated as a short term capital gain, you're getting treated at ordinary income. It's getting taxed at a much higher rate that most of the people on this call are dealing with. Typically, it makes more sense to put those into accounts that are what's considered tax deferred so that you don't worry about realizing those taxable gains today. Conversely, in some of those after tax accounts or those non-qualified accounts, that is where you might want to own some of your more growth oriented stocks, stocks that are more passively owned and passively traded that do not kick off those short-term gains. And as long as you do not sell, will not trigger a capital gain, whether it be long-term or short-term. The other thing to consider is what is the future tax treatment of it? We are big proponents of owning a lot of growth stocks and growth funds in your Roth account. The Roth account will eventually generate tax-free income in the future. So if I want to try and grow my assets at the greatest clip, I want to do so in one of the most tax advantageous buckets I have, a bucket that when I distribute income out in retirement, I will not pay taxes on. It will not count towards my IRMA, which I mentioned earlier, but let me clarify. IRMA is the income-related monthly adjustment amount. That is a surcharge that is charged on your Medicare premiums in retirement. Roth distributions do not count towards that. So again, as Matt mentioned earlier, there's preparation and there's planning. Making sure you understand why you're saving what and where you're saving it is key towards setting up an efficient future, both for you and your loved ones. Pam, next slide, please. I just mentioned this, that asset location, most people focus on asset allocation. And while asset allocation is an imperative and key part to any successful strategy, asset location should not be overlooked. It is a powerful strategy that is going to make sure that your assets are owned in the most efficient manner possible to allow you flexibility in the future and take advantage of certain situations. The reason we do this is because typically high earners who optimize asset location and own assets in the right tax treated vehicles can typically add 20 to 60 basis points of after tax return annually. Think about that. It's not that we're telling you we're going to invest it any better or we're going to do any better, but by eliminating or mitigating the tax drag on these assets, It keeps more money in your pocket and less in the government's pocket. We help you align the asset location with whatever goals you have for the future and whatever liquidity needs you have for today. The key is having multiple buckets for different years, different strategies, and different times. Now, all this talk is great, but what we're going to do here is show you what it looks like in terms of numbers. So what we're going to take here is two separate scenarios. One is a traditional IRA. The other is a brokerage account. So this is money that is put in and funded in an after-tax basis. Both accounts are going to be funded with $70,000. They're both invested the same way. They're both going to earn $50,000 of growth. At the point in time where we go to take that money out, what you're going to see on the left side in the IRA is that all of the money, because tax has never been paid, it is all going to be subject to ordinary income. At that $120,000 number, you're putting yourself at a 24% effective tax bracket, which essentially is going to give you a tax bill of $28,800. As Matt mentioned, we are located here in New York. We add the New York tax of approximately 6.5% to add another $7,800 in taxes. So at the end of the day, you're going to pay just under $37,000 in taxes from a $120,000 distribution. That's going to leave you with about $83,000. Now, same scenario, just invested in a different tax vehicle, a brokerage account where only the gains are taxed, same $70,000 investment, same $50,000 of growth, same $120,000 of liquidation. You're going to see that you're going to pay long-term capital gains of 15%, but you're only going to pay it on the $50,000 of gains, not the original $70,000. So that changes the federal tax from $28,000 or almost $29,000 to $7,500. Again, the long-term capital gains on a smaller amount, not 120, but rather that 50, brings you down to $3,250. So your total tax on the gain is roughly $11,000. Now, we do have to factor in that you did pay tax on that original $70,000, and that's going to be roughly $22,000. So at the end of the day, same dollar amounts, same investment vehicles, same distribution, it nets you roughly $4,000 more in net money in your pocket just because of the tax treatment with how the buckets were managed from a tax perspective. If we did the same exact thing with a Roth, you would see that there wouldn't be long-term capital gains, there wouldn't be state gains, and you'd actually take more home. So again, being intentional with where you save and how you save is imperative towards setting yourself up for a successful future. Now, I keep mentioning Roth as an alternative, and what most people may say is, well, this call is for people who are earning a lot of money. I am ineligible due to some of the phase outs that Matt mentioned earlier. I cannot contribute to a Roth IRA. And in some cases, you're correct. But the government does allow for what is called a Roth conversion. What a Roth conversion is simply put, taking that free tax money that you have in a 401k or in an IRA and converting it to a Roth account. Essentially, it becomes a distribution for tax purposes in the current tax year. You will pay taxes on the entirety of that conversion. And then from that point forward, the money that goes from traditional to Roth is now growing on a tax-free basis. When you're looking to do a Roth conversion, it makes sense to do so if you happen to be in a lower income year, if you're concerned with where your RMDs are going to be in the future, and you want to try to mitigate your taxes or spread your tax hit over multiple tax years. I've mentioned this in the past. It creates flexibility. Having the ability to have multiple buckets to withdraw from based upon what your immediate and long-term needs are is going to set both you up today, you up tomorrow, and your loved ones in the future for a much more successful strategy, and making sure we keep more in your loved ones' pockets and less in the government's pockets. As you see there, it is a much more tax advantage asset transitioning to the next generation. So when does it make sense to convert? Well, simply put, it makes sense when things are lower than they typically are. If there happens to be a volatile market and the market is down 20%, listen, it's that old saying, if you love it at 20, you're going to love it at 10. Well, let's sell it at 10, pay taxes on it at 10, invest it in a bucket that's going to grow tax-free, and let it come back up to 20. Now I've just transferred all of that growth into a tax-free bucket because I moved it out at a depressed market at a lower point in time or a lower value. Let's just say you're in a transitionary period. You're going to retire, or you're going to take a sabbatical, or you're not quite sure what you want to do and you want to take time off to backpack across Europe. If you're going to be taking time off and your income is going to be lower this year than it has been in years past or will be in years future, why not take advantage of that lower tax bracket, pay the tax now, let it grow tax free, and give yourself more flexibility in the future? One of the key topics we discussed in our previous presentation, and Matt touched upon, is RSUs. Some of the people on this call are going to be paid in restricted stock units where they're going to be given large sums of money in the form of stocks. They will realize those in terms of their vesting schedule. Well, if you have a light vesting schedule or you have less RSUs vesting in one calendar year as opposed to another, you're technically going to have a lower earned income. Perhaps that's a good time to transition or convert to Roth and take advantage of the lower tax bracket you are in. We also mentioned RMDs, and it's a great time for a lot of people on this call. They may be looking to retire early, retire at say 55 or 60. Well, for all the money that you have in those pre-tax buckets, the government's not going to force you to take those distributions until 73. If we have a 15 to 18 or 20-year window between the point in time you retire and the point in time where you have to take those distributions, we can look to try and fill up certain tax buckets and transition that asset to, again, create more flexibility in the future. The key is always looking at where your income is today, where you expect your income to go, and planning with a purpose and an intentionality. I mentioned IRMA. Typically, when you look at what counts towards IRMA, it's just about every bucket most people are saving in. It's your traditional IRA, your traditional 401k. It is your non-qualified brokerage and stock portfolios. It is your CDs that are not in retirement accounts. It is potentially selling businesses, selling real estate or rental properties, investment properties. So managing the brackets that you're in and what the potential future IRMA exposure that you may face from age 65 on when you're on Medicare is an often overlooked issue that most people are not aware of. When people are planning for retirement, one of the most basic forms of retirement income they have is Social Security. But if you happen to be a high earner that has saved a significant amount of money, the amount of money that you draw down in retirement could put you in larger tax brackets where the cost for your medical expenses or your medical insurance could be astronomical. If we were to consider a 65-year-old couple today that is going to retire at 67 and both live to 90 in regular Medicare premiums based upon what Medicare has told us the premiums are going to grow to, they're going to pay $893,000 throughout that life period. So in that 25 years between the two of them, $893,000 in Medicare expenses. That's just Medicare alone. If they happen to be in the third IRMA bracket, which is a joint income of about $312,000 or more, that $893,000 grows to about $1.7 million. That's an additional $800,000 in bills that may not be avoidable, but it may be able to be mitigated. Taking advantage of certain conversion periods, certain low income periods, and getting assets from a pre-tax account to a Roth account, again, it gives you a quantifiable tax amount, one you won't have if you don't know where future brackets are, but it could potentially lower your IRMA exposure and your IRMA expenses significantly, thereby, again, leaving more wealth on the table to pass on to your loved ones. Again, we talked about it. I think the key to any type of bracket management, any type of Roth conversion, anything when you're doing this planning, it's to have a multi-year plan in place. You do not want to do a large Roth conversion in 1 year. Instead of converting 500,000 or a million in 1 year, doing so over 5 or 10 years spreads the tax liability over multiple years, leaving more money in your accounts and less in the government's. Again, as I just mentioned with the multi-year conversion strategy, it makes sense. What we can do is we can take a look at what your income bracket is now. How much room do we have in that bracket before earning too much and putting you in a second bracket or a higher bracket? Let's maximize that bracket and convert as much as we can while keeping you in the same tax exposure you're currently in. What it also does is it helps to reduce future RMDs. The more money we have outside of those traditional buckets and in Roth, it eliminates the need to take those distributions because the government's been paid. They're not saying we've let you defer taxes long enough and we want our piece of the pie. You gave them their piece over the years. You converted everything. You create tax diversification. You now have assets that will provide tax-free income, assets that will provide taxable income, and assets that will provide income on a capital gains basis. It gives much more flexibility and allows you to take a look at your retirement timeline and plan properly. When does it make sense to take from this bucket? When does it make sense to take from that bucket? You've given yourself options. And in life, having options is one of the best things you can have, because the last thing we want to do is do something that we're forced to do and not something we chose to do because we had an intentional plan or strategy in place. At this point, I'm going to hand it back to Matt and let him take it home from here.
All right, so we're going to talk quickly about a strategy called Mega Backdoor Roth that some of you may have heard, right? So what is it? You know, it allows for after-tax 401k contributions, and the idea here is to convert those after-tax 401k contributions to a Roth immediately. We'll talk in a minute why immediately is important, or as an in-service rollover. So without getting into the minutia and details of it, essentially what a mega backdoor Roth allows is for us to contribute an additional $30,000 to $40,000 of additional Roth savings that we normally would not be able to do. The catch is it's only available in certain employer plans, but this is an ideal strategy for high earners that have a strong cash flow, that have the ability to save money, and now we can save it into a Roth account. Right? So why is it a powerhouse, right? It significantly increases Roth savings capacity, right? It allows for tax-free growth to compound faster. It reduces our future taxable income, right? So, when we're in retirement, it complements equity compensation planning, and it creates long-term tax diversification. The eligibility and the pitfalls, right? So the biggest one is that your plan that you have through your employer must allow for after-tax contributions. If it doesn't, then unfortunately, this is not a strategy that you're going to be able to take advantage of. Jeff will talk next about another strategy that can complement this if you don't have access to it, right? Plans also, not only do they have to allow for after-tax contributions, they have to allow for in-plan conversions, right? Because timing with this really matters, right? It's a two-step process. We have to first fund the after-tax account. Then the second step is that you have to roll that into the Roth account, right? A lot of people fail to do that second step, which kind of mitigates a lot of the benefits of this. You also have to watch for employer match rules, because you're only allowed to contribute a certain amount into your 401k between your contributions, the after-tax, and then the match. And a lot of people forget about the match, and sometimes they inadvertently contribute to the after-tax account when trying to do a mega backdoor Roth. And lastly, it avoids excess contributions. Very powerful strategy. Management of it is key. It's very easy to make a mistake, so you got to be very careful with it. But as long as you do it appropriately, very powerful. And that leads us into the third strategy, which Jeff will talk about, which is life insurance.
Sure, leave me the exciting stuff. Pam, go back for a second. I want to take a pause a little bit because, we threw a lot of information very quickly in a short period of time. So when we talk about tax planning, especially at higher income levels, it can very quickly turn into tactics, charts, rules, and while those are generally important, in the grand scheme of things, a lot of times what people fail to recognize, what's the most important thing is the context, right? What is the intent? right? What's the goal? What's the future, planning? And that's where planning comes in, right? Things you have to really consider every time you make a decision. What's my income trajectory for the next 5, 10, 15 years? What's my equity exposure? What's my career timeline, right? Where do I live now? Am I going to be living in the same place, right? All these are important conversations that are going to help you make help you make decisions that are flexible in nature, right? And like Rob just said, flexibility is the most important thing. So uh, without that context, right, even good strategies can be mistimed, they can be missized, and at some point could be even counterproductive, right? As I'm going through this, I'm thinking of a scenario that happened about 2 years ago. A client came to us, hired us, said, "Look, I need to do estate planning. I need to do retirement planning. High earner, high net worth, certainly. Net worth of upwards of 20." And while they had done estate planning, which was good in nature, right? Nobody would look at it and say, "Oh, this is bad planning." It wasn't done with the right assets, right? So they ended up giving assets that they would normally wouldn't want to give away, right? We always start, talk about, when you start gifting, you give away assets you won't need, right? So in this particular scenario, they gave away the thing that she needed the most, which is income, right? Instead of giving away assets that don't generate income. So she found herself in a situation where for her entire life was a high earner, was able to save, didn't really need a lot of the money that she had given away, but now she wants to retire and she doesn't have any income. She's broke, even though she's worth $20 million. So the point is, the goal isn't to do everything, it's to do the right things in the right order at the right time. And really, that's the most powerful thing about you should be walking away with this conversation today with what Matt has shared and as well as Rob. Okay, ready for the next slide. Sorry about that. I just needed to kind of preface it as we kind of get to the end here. Life insurance is always a fun topic for me to talk about because it's one of those things that I usually end up saying this to anyone who talks to me about buying life insurance later in life. The reason you buy life insurance today is not the same reason you're going to buy it tomorrow or you're going to need it tomorrow. With that mindset, right, you should think about life insurance, specifically permanent life insurance, as a great tool for high earners, and it can serve both as a protection tool as well as a tax advantage accumulation vehicle. The cash value grows tax deferred. You can access it through loans and withdrawals. The death benefit is income tax free, and it's not a replacement for a retirement account. It's not what I'm saying, but it does add a very unique level of tax diversification. Because think about a scenario where you're ready to retire, all your money's in qualified plans. You have to take your money out, but if you take it out, you're going to get taxed. But the market just went down 20%. So where cash value life insurance provides an alternative is that, hey, I have a bucket of money that I haven't touched for the last 20 years. It's tax-free. I can take it. I can take a withdrawal. I can borrow against it, and not tap into assets that are depressed because the market is fluctuating too much, right? So the biggest distinction we see, and I believe Matt was the one that spoke about this. Preparing a tax return is preparation is filing a tax return. Planning is designing a lifetime tax path, and most people, even successful ones, they spend the majority of their time in preparation. They usually end up calling us when they're reacting to what already happened. I made a lot of money, RSU problems, I got a bunch of bonus money, and now I'm stuck with a huge tax bill. Planning, on the other hand, asks the different questions. The questions that you should really be asking yourself is, when should income be recognized? Where should my assets live, right? And Rob went through that. Asset location is very important. And which dollars should grow tax deferred, which should be tax free, and which should be taxable, and how are today's decisions are going to impact future tax brackets, RMDs, Medicare premiums, and estate taxes. So our objective is very simple. Reducing lifetime tax drag is not just to minimize today's or this year's tax return, but actually shifting your mindset to being proactive. And that's where the leverage shows up, the long-term impact of that tax drag. So when planning, is done well, the result is not complexity, it's clarity. You gain control over when income shows up, where assets grow, how cash flow in retirement looks like. So all of these things, these locations, Roth conversions, and tax simplifications we're talking to you about alone, they're just not moves. They're design decisions, and they're only going to work together when they work in conjunction with one another, right? Life insurance is just another, it's just another tool in that bag that a standalone, you see no benefit with. Why would I do that? Why would I pay all these premiums and my yield is going to be 4 or 5%? But when you look at it in the context of, hey, I'm comparing that to an asset that can grow 10%, it's a no-brainer, right? You always go for the 10% yielding assets. But when you start taking into consideration, again, how quickly your estate is growing, one of my favorite topics to talk about is estate planning, right? Because especially with high earners, and we're dealing with a guy right now that he himself was earned $400,000, $500,000, $600,000 a year, made some good purchases of real estate, but he never really considered himself a millionaire, right? And we showed him a balance sheet, and all of a sudden, oh my God, he's like, all in, I'm 12, yeah, and that's not including your life insurance, right? So we talk about life insurance, and at this point, he's in his almost 60s, right? He knows he has a tax liability of $1.5 million, but he has term insurance. And he's like, well, somebody told me I should have bought permanent insurance. I'm like, well, it's something to consider, right? So again, going back to the question, he bought that 20 years ago. It's at the end of the term, and then life insurance all of a sudden is coming up as a conversation. And I use my line. Look, the reason you bought that policy 20 years ago is not the reason you need it today. Now we're looking at a greater problem because you did a good job saving, because you did a good job accumulating wealth, right? Those same moves that got you here are not going to get you to the next stage, right? You have to change the strategy. You got to change the mindset of what you're doing. So with that, I hope that, what you've heard today forces you to ask one question of yourselves. Do I have an intentional tax strategy that evolves with my life? At the end of the day, that's what we're here for, is to help you think outside of the box and look at things from a perspective that hasn't been done before. I think we have some Q&A after that. Rob, I think you're finishing up this slide, right?
Yeah, we had a couple of questions come in. One comment that I think is actually a really valuable piece of information or thought from Stephen Bonfa, that when you go back and you talk about those IRA distributions, another consideration to kind of look into is, everyone who is a parent has one goal for their parents, and it's for their their kids to do better than they did. So what happens when you succeed in that, and now your child is earning more than you are? It may be a more valuable strategy to take the IRA distribution as a parent in a lower tax bracket and leave it in a more tax favorable bucket for your son, daughter, who is earning more money. Stephen, great point. We appreciate you bringing that to us. Another question we have, I think it kind of goes over some of your last slides, Jeff. How is life insurance a tax advantaged account?
Tax advantage, it comes from the ability of paying premiums for 5, 10, 15, 20 years, grows tax deferred, right? At some point, if you needed that cash, right, that cash is, you have ways to pull that money out either through withdrawals or loans that you don't have to pay, you don't have to necessarily pay back, right? But as long as that policy, right, remains in force the day you die, even with loans, those distributions are tax advantage. You're not paying taxes on that, right? So hypothetically speaking, you put in $100,000 over the course of 20, 25 years, the cash value goes up, goes to 150, 170, and you just find yourself in a bind, or you just want to, turn that into an income stream. The insurance company, or a lot of insurance companies, have the ability to turn on that income, right? You're not going to get back your, a 1099 at the end of the year, because you're getting your own money back, right? And because it's a life insurance policy, right, it is expecting that at some point it's going to be a tax-free death benefit. So I hope that answers the question, but that's one of the benefits, one of the main benefits I see, and why life insurance is a tax-deferred or tax-advantage, vehicle, right? Another way I would say to look at it, or look at life insurance with cash value, is specifically ones that are not tied to the market. So permanent whole life policies offer a unique, comparison to bonds, right? Like if you already have, a portfolio that's, 60-40, right? 40% of that portfolio is if it's in bonds or cash equivalents, you should look at the cash value inside of a policy that's growing at an average of 4 to 5%, right? Not guaranteed dividends, right? But at least it's not fluctuating like everything else is. So again, that is a way to look at it as well. It's an alternative than just having money parked in say $100,000 in bonds. That same $100,000 in a life insurance policy could significantly, if you leverage the insurance, that $100,000 could be buying $1.5 million of death benefit, right? And because it's liquid and because you have access to it, what's the difference between grabbing $100,000 in bonds or cash value? It just means what hand am I using to get at it, right? That's how practical you should really look at the tax position around that. So anyways, I can ramble about this for hours. So I hope I answered that question. Anything else,
Thanks,
Rob?
Jeff. Yeah, next question was, how do I know whether a Roth conversion makes sense for me this year versus waiting? And I think I'll jump in on this. One of the things that Jeff brought up in the beginning was that we try to take a cross-disciplinary approach between legal, tax, and financial. And whether you choose to work with us or with anyone else, I think it's imperative that your attorneys, your accountants, and your financial planners are somehow communicating and discussing what strategies they're implementing and why. We always equate it to a doctor who's going to look at all the medicine you're taking and making sure a new prescription is not going to react negatively against some of the other ones. So when you try to decide when's the best time, is it this year, is it next year, having a plan where your financial planner is talking to your accountant, discussing the strategy, seeing how it's going to flow in with your tax return, seeing if it's more advantageous to do it this year because income is lower than normal, or waiting until next year because you had a banner year and you don't project to make this kind of money again. The key is making sure that there is collaboration amongst all your trusted advisors so that what you do with one doesn't derail what you're trying to do with the other. And then the final question is, what's the best way to decide which investments belong in my taxable account versus my IRA or Roth? Matt, do you want me to handle it? Do you want to jump in and take it?
Sure. Yeah, I can comment on that. So, there's a lot of things to unpack. One common example that we see with that is municipal bonds, right? So for those of you that aren't familiar, municipal bonds pay tax-free interest. So for high earners, it could be really advantageous to invest in municipal bonds. But it probably wouldn't make sense to buy those investments inside an IRA or a Roth, right? Because any of the interest that any of the investments in an IRA or Roth earn are not going to be taxed at that time anyway, right? And you do take a little bit of a hit on how much interest you earn with a municipal bond versus a corporate bond or a U.S. government bond, which pays a little higher interest. But when you factor in the after-tax benefits, for a high earner, a lot of times munis make more sense. So, a classic example is municipal bonds can be a great investment for high earners, but in a taxable account, it makes sense. It doesn't make so much sense in a Roth or an IRA. So kind of looking through the specific tax treatments of different investments and making sure that we're not only are we investing in the right securities, but from a tax perspective, are we buying them in the right account is really, really important. The only other thing I would say on this as well is, depending on your age and proximity to when you're going to be taking withdrawals is really the most important thing, right? For a 30-year-old, the securities they're purchasing in an IRA or a Roth probably are going to be better suited to be more on the aggressive side than somebody who's 60 or 65 and potentially retiring in a few years, right? So outside of tax benefits, proximity to retirement and when you're going to need those funds, as always, with any kind of investing, is one of the most paramount things you have to look at.
And if I could add to that, we're big proponents of owning growth-oriented assets inside the Roth. If you can have most of your growth happening in a bucket that's going to be tax-free in the future, that's where I want it to grow. I want it to grow where I know I'm not going to be taxed on it, as opposed to one where I, chose not to pay tax on $1 and let it grow to 20, and now I have to pay tax on 20. So again, it's the intentionality of knowing why you're doing what you're doing and changing it as your life changes, as your needs change, and as your goals and objectives change.
We got one more, I think it's more of a statement, not a question. Life insurance is not on life insurance on kids, not banking on kids passing, but giving them a great asset when they're older or hedging if they later become ineligible for health. I don't know who let this guy in, but great point. Life insurance is, I love anytime anybody talks about life insurance, it warms my heart. I have life insurance on my kids. I have two of them. I bought life insurance, permanent whole life insurance on them when they're both one, right? So I'm a big believer that, for that very reason, right? It's not that you're banking on kids passing, but it's so cheap. I mean, my God, I spent a lot of money on dumber things, and to throw 100, $200 a month on an asset that by the time my kids, hit, college, there's money there for college, for starting a business, or, weddings, cars. Not that we're going to do stupid things like that, but, and my goal is, look, at some point when they're older and responsible, give that to them. That is a gift, right? Because, if they don't touch it till they're in retirement, I mean, it's powerful, right? And you're moving money, in a very powerful tax-free way. Most wealthiest families in this country and a lot of our clients, the ones that understand money, they love life insurance, permanent life insurance, because it's an easy way to transfer tax-free wealth. And so thank you, Stephen, for that point. So life insurance, on kids is a good thing. I think it's a good thing. I don't think it should be the only thing, right? So let me make a point, right? If people say, this is all I have, what should I do? I think that there are other things that are going to have a better growth trajectory. But again, the tax benefits that life insurance brings to any scenario, I think long term is the one thing that I think makes it a special tool. So thanks, guys. I appreciate the time.
With that, again, that's going to end our presentation today. We appreciate everyone for coming, and we ask that you please keep an eye out for the fourth part that we'll be sending out in a matter of weeks for when that date will be.
Thank you. Again.
Thank you, everyone.